Good morning all and welcome to today's video. So today I have two pairs on watch and those are Euro Aussie and Kiwi Yen. So I haven't had anything on watch for this week and the market is just the structures that we look for. There's been nothing even remotely comparable to anything that I've learned to see that typically plays out, which has shaped up so far this week until today. So I've been happy to sit on the sidelines. And I was literally just thinking, literally just before I started this video, about how we often see that in security, for example. Okay, when nothing happens for a while, what I mean by this is it's a dangerous game. When you start saying the market is slow, okay, the problem with that, even if there's truth in that statement, is that if you believe something to be slow, you take your eye off the ball, and you see this in security, for example, in that profession. I'm actually from Windsor originally, and it reminds me of an instance at Windsor Castle where I think there's been a couple of instances, but one, there was a fancy dress party going on at Windsor Castle. Bear with me, there is a point to this. And someone who wasn't on the guest list managed to get in. Some of you may remember this. Someone managed to get in dressed as Osama bin Laden, right? Okay, and no one questioned him. Why? Probably because there's not many security breaches at Windsor Castle. The security is very tight. There's always soldiers on the gate. I've been there, been past it numerous times. There's always police on the gate with guns, and they probably get a little bit sloppy from time to time because not very much happens. I remember an example many years previous when I think there was two guys from Eton College, which is just across the River Thames from Windsor, and two drunk guys from Eton College managed to climb the castle walls and get over. I don't even know how you managed to do that. I've seen the walls, they're very high, but somehow they managed to get over and no one did anything. There was another example where when the Queen was alive, someone managed to break in, get past security and break into the Queen's bedroom, and the Queen was apparently having a conversation with this guy who was in a just stood there in her bedroom. So the point I'm making here is that when you believe something's slow, you take your eye off the ball. That's the point I'm trying to make here. So it's important as traders. I don't use the word slow just because I know that even if the market is slow and I take my eye off the ball, you then potentially miss the entries that do shape up. So I went a bit abstract there, a little bit off topic, but hopefully you see my point. Okay, so even if the market's slow, keep your eye on the ball because you never know when it's going to be fast, if you wish to use that terminology. Anyway, let's break down these pairs. So why am I looking at Euro Aussie? I am looking at Euro Aussie on the higher time frames because we have this high here. Okay, what happens? We near miss to this high, we come back down, which and then we come back up. We find liquidity from this base here. Okay, so we near miss. That always gives me the indication that we're going to come back up, take out the high before moving to the downside, which is what happens. Okay, so we near miss to that area, we push to the downside, find liquidity from here. We then get a 1, 2, 3 leading into that, which gives me a clue that we will likely, this is likely us keep catching people the wrong side of the market before the move to the downside. One of the clues was if we measured this, okay, and we assume that the continuation leg out of the impulse correction continuation is of a similar length, you can see that we'll fulfill that move. We measure it from the break as well sometimes because the volume that's been built up there can dictate how far out we actually go. But we didn't fill all of that, but we certainly filled the first part of the move. Catch people the wrong side of the market, and then we push to the downside. We then have this impulse correction continuation. We then move into a larger correction, just about tap this high, more or less. This becomes the middle section. And then as we drill down, this would have been better if it was, you can't see it so much on the, you think, well, why is price reacted from here? Okay. So what I'm seeing here is I'm seeing this is the completed piece of structure because we have that, we have the middle section. Okay. If I take this away, We can also see, so price scooped up here, scooped back up. We kind of have this. You can see the three drives there: first drive, second drive, third drive. We move to the downside. Price breaks the low of this, leaves a footprint, which just so happens to be the start of this running channel. Okay, so this is where volume was built. Okay, volume was built here in this running channel. So I'm not surprised that price gravitated back towards the start of the running channel. Okay, there was a little sharp move there, but that was where all of this volume was accumulated. What happens? Here was the other clue that there was volume there, is that we near missed to it. We come back down, we come back up, we near miss to that area. We tap into this area, the previous near miss, but we near miss to the start of that running channel, which gives me a clue once again that that's all the volume, where all the volume is. The other clue was if we measure this, so we have this impulse correction continuation. If we assume that the last leg is of a similar length, what do you know? That takes us up to bang on where the area of value is. So I'm seeing this as an ending structure. This is the middle section. We pop just above, catch people on the wrong side of the market, and then push to the downside. So structurally, all of this so far makes sense. Okay, we then have, if I just get rid of that, then what happens? We smash through the low. Okay, we smash through the low and then form a correction afterwards, giving me a clue that this is now an impulse correction continuation to push lower, because if we measure this, the pole from there, and we assume that the leg out is of a similar length, that would take us down to there, and then potentially this whole thing becomes a middle section. So this becomes the middle section. We then push up to take out this high there, okay, or even that high there, and then perhaps we move to the downside from there, and then this becomes a 1, 2, 3, okay, and then this becomes what we call an expanding pattern, but that's a little bit more longer term. The clue that makes me think that we are, and why I've got my area of value here, you might be thinking, well, I can't see an area of value. Well, if we just zoom down to the 1 hour chart, you can see. So yes, we've rejected from these lows, but how have we done it? We had this scoop double bottom, and if, generally speaking, if we were going to move to the upside from there, we wouldn't see this kind of exhaustive price action. Okay, and if you look closely, you can see that we have a little inflection point there, which just so happens to be the retest at the back end of all of this. So I'm seeing this as a potential 1, 2, 3. Okay, this may not happen by the end of the day, but look at, yes, we tapped into that high, but how have we moved down? We've moved down correctively, suggesting that the next leg will be an impulse up. When we move down correctively, usually we see an impulse up. And if we did that, that would complete this 1, 2, 3 touch structure. This whole thing becomes the middle section. We'd likely see an impulse out there, likely tap into where there was a sharp move, which is likely where the liquidity is. And that would be the retest at the back end of that previous low. And what I would be looking for is, if that was to occur, I'll be looking for price to tap into the area of value, a 1 hour impulse down, okay, and then either a 5-minute continuation, so 6 to 8 corrective 5-minute candles, and then I would get short on the break with a reduced risk entry. Or if it was 6 to 8 corrective 15-minute candles as a minimum, then I would look once again to get short on the break. But I would also be looking, if we got the two bottoms, for the risk entry within the flag. Okay, 10 pip stop loss as a minimum. And then I will be able to manage it down to that wick there, and even just down to these lows here, if you wanted to cut through that wick for something in the region of 3%. And then even just down to this base here, I wouldn't expect it to stop there, but I would expect some profit taking in that area, which may cause the deeper pullbacks. You would have something in the region of 8%. And what I would do is I would measure from range to range. So the range being there to there. We know that the 90% rule, the 90% area, is typically where we pull back sharply and can pull back about 50% of the move. And rather than leave 50% or several percentage points, 50%, several percentage points of that move on the table, what I would do is set a take profit there, and I would simultaneously trail my stop loss accordingly. So that is Euro Aussie. So just going to leave that. That may not be ready by the end of the day. It may not be ready at all, as I often say, and they often aren't ready. But that's not for us to determine. We just have to, as I said, stay on the ball, even if the market doesn't look like it's going to shape up, for the reason given and the examples given. Right. So Kiwi yen. If we just take that off, I don't know why Trading View has done what it's done again. Right, there we go. So on the higher time frames, we can see, if we zoom right out on this one, you can see that we had this area of value here, and we have this kind of inflection point. I say inflection point because the start of the move, okay, when we've pulled back this far, the start of the move was here, okay. So I am anticipating that at some point we come back up, because if you look what's happened here, we near missed to this high here. I am expecting at some point, or anticipating rather, breaking that high before the move to the downside, but we still have this inflection point. Look what happened here, okay? So what happened when volume was triggered here? Volume was actually built and triggered here. It was built within this channel, okay? Look at the sell-off that occurred. That's a very aggressive sell-off, given that this is the weekly chart. So typically speaking, when we tap into areas of value and inflection, we typically rally or sell off with a similar level of aggression as we did last time around. Okay. And if you just look what's happened, we broke above, caught people the wrong side of the market, and we have completely capitulated to the downside. Okay. And if we just zoom in, the picture gets a little bit clearer. Now, this could be, once again, I touched on previously how we kind of had this structure leading up to it. Okay. This is a key point here. We had this structure leading up to it, but I said, look at how impulsive the middle section was, okay? Normally, the middle sections are more corrective, as you've probably seen from how I've drawn them on throughout this video, okay? So when I see a three-touch structure which breaks above, okay, and then comes back in, that gives me a clue that because this middle section was impulsive, that this, if I take these off, that this is potentially the middle section within itself, okay, to give us something like that to push up, to break that high that we near missed too. So when I see an impulsive middle section within the three-touch structure, particularly when the third touch and the break back in beneath the third touch has near missed to a more significant area of value, that gives me a clue that this whole thing, that this near miss is actually part of the middle section, okay, and that we get something more like that, okay, and this bit is more corrective for that move up, which then breaks the high, and then we move to the downside, okay. So just little details that I've picked up over the years, which I thought might be helpful. But again, that doesn't mean that we can't capitalize on a move to the downside in the meantime. There is the possibility, which is partly why this is lower down on the list. If you just look at this, okay, we have a near miss here to this area of volume, a near miss here to here, and to some extent a near miss here. So there is always that possibility that we just break to the upside and price to something like that. Okay, then we move to the downside, and that would look more like that middle section that I was just talking about before that break of the high and then the break back in. Okay, so those near misses could be a bit of a clue as well. But as things stand, okay, we do have, if we just separate the structures, we have a little running channel. Okay, we kind of have this. It's not the prettiest, but we have this three-touch structure there. That's the middle section. Okay, price leaves a footprint there. This, we kind of have this kind of M-style pattern where price starts to move to the downside. It becomes too voluminous. We break this inflection point, move to the downside. We have a similar structure here to what we had, where was it? Here, okay, where this is the middle section. We break that structure, leave a footprint, And now what I'm seeing, so this is pattern separation. This is something which is can be particularly helpful to help you determine if prices move down a little bit correctively, all in all, as it has here. Pattern separation can be something which helps you to determine where one structure starts and another one ends. And with all that in mind, what I'm seeing here is I'm seeing this as a piece of its own, okay, where we have an impulse, correction, continuation, which would just so happen to line up with the area of value where there was a sharp sell-off last time around, okay, giving me a clue that we'd likely get something similar again. Okay, we may near miss it. We may not get all the way there because we've near missed the previous high throughout this move. Okay, but what I'll be looking for in this instance, and we're just going to take the old alert off the chart there. What I'll be looking for in this instance is I'll be looking for a tap into the area of value. And because of all these things considered, what I'll specifically be looking for in this instance, so tap into the area of value, I'll be looking for a 1 hour impulse down below the area of interest. So below area of interest, I mean the base of this structure here, which would just to touch on it, that would also put us below these highs here. Okay, so if we tapped into the area of value, pushed down, and we were trading below this high here and below this area of interest here, that would be very intentional in my opinion and experience. And if we got a correction afterwards, which would be the confirmation that we would look for, that price isn't just going to just tap us in, let's say, one candle and then start moving to the upside, which it could. The correction afterwards would be the confirmation that price is well and truly on its way to the downside. If you imagine what that would look like on the 4-hour chart by that point, that would be very intentional. A tap into there, break below, trading below, a correction below there would be very intentional for a move to the downside. And then I will be able to manage this down to the low of the structure. So same as what I was looking for with the previous pair, a 2-touch 5-minute continuation, reduce risk entry on the break of that, or a 2-touch 15-minute continuation and a 5-minute risk entry within it, or a reduced risk entry on the break. And then I'll be able to manage it down to, if we got to this low here, we would likely find our way all the way to the base, which would give me something in the region of 5%, 5.5%. And then what I would do in this instance is I would use the mechanical management tool. You might be thinking, why wouldn't you just set a take profit there? It's more about how much, excuse me, it's more about how much profit you would actually leave on the table. And if I've only got 5% profit to the low, I tend to like to set a take profit at the next notable area of value, which would be down here. Okay, because when you're only dealing with a small amount, the pullbacks proportionally don't represent as much of a pullback in profit terms, okay, in percentage terms when it comes to profit, as opposed to if this move from here to here was like 8% or 10%. So what I would do is I'd set a take profit down there. I would trail my stop loss accordingly, and then we would have something in the region of 14% to work with, and that would be a very nice trade. So notice how this is lower down on my list, even though the profit potential would be greater. And the reason for that is because the amateurs are trying to get rich quick, and the professionals such as us, those of us who trade the Falcon strategy, we're risk managers. Okay, so I'm prioritizing my pairs in terms of which one would allow me to manage risk more easily, as opposed to which ones would give me more likely to give me a home run trade. Okay, look at this one. This to me looks more intentional. Everything about this looks more intentional than this one, although I do like the look of this structure. Okay, so risk management first, profit second. Okay, if you do it that way round instead of the way round that the amateurs are doing it, I promise you'll be more profitable or lose less money. Okay, hope you've enjoyed this video, folks. If this entry, if it just sells off here as it's starting to do, I believe we've got some economic data coming out of the UK at 8 a.m. It is 7:21 as I speak. If this doesn't give me an entry, no problem. We move on. Okay. Hope you've enjoyed this. I'll see you in the next video. Thanks for watching.